Today we are exploring the polynomial regression channel. One of my favorite indicators because in one indicator you have multiple information. So the polynomial regression channel is making the polynomial regression analysis to show in a non-linear way market directions, also helps to create some sort of an envelope based on the current market data, of course, create some sort of dynamic support resistance in again a non-linear way. So instead of a single simple line trying to connect the highs and the lows, the PRC, the polynomial regression channel, basically what it does, it feeds a curve regression line through the price data we have from the market. Okay, so with the current data, it makes this calculation, the third regression, and what you see here is this sort of an envelope, you could even say kind of parabolical channels. So this indicator, the reason I love it, it kind of all-inclusive indicator, all the information you can get in one indicator. It shows the dynamic support resistance, it shows trending market conditions, it shows potential reversal spot, extreme overbought, oversold, and it shows amazing trading opportunities. So let's see, where do we find it and how it is used. So we go to the indicator sections, volatility, and second from the bottom, the polynomial regression channel. These are the default numbers. Of course, you can play with them and adjust the visibility and the line types as per your preferences. The result is what you see on the chart. Again, a curved, nonlinear, parabolic result of a channel that helps us to spot all the conditions I mentioned before. So trending, like you can see clear rising channel. We are in a clean bullish market condition, as simple as that. When the channels are flattened and they do not gain any specific directions, the market is in a range. Classical conditions, by the way, to look for buy and sell within the channels. And of course, when the curve is bearish, we are in a bearish phase of the market when the slope here is bearish. There are several ways to use that, while the most common one, overbought, oversold, especially in ranging conditions. Okay, when this channel is flat. Overbought is when the market is going above the upper part of the band. That means that we are in overbought conditions and very likely to drop down back inside the channel many times to reach the bottom of the channel. And the opposite way is when we go below the channel. That means usually we are in oversold conditions and the market is very likely to retrace back inside the channel and many times to reach the opposite direction. Another very popular way traders love to use that is when they spot trending conditions, which means the slope and the direction of this channel is in a given direction, bullish or bearish. Wait for the retrace to the opposite band, and from there look for the price to bounce back and join back the trend. These are the most common uses of this indicator and very, very powerful ones. And another not so common, but still a way the traders use that is to verify breakouts, especially after given trends. For example, when we are riding a trend, in that example, a bearish trend, clearly you can see the direction of the channel is bearish and the price drops down, making lower highs, lower lows. And what happens after that? It flips to make a rally. It's the channel starts to climb and we get the break. Look what happens here above this high of the price. right? The market goes, closes here. Look what happens here. Closes above the high, bouncing from the bottom of the channel, and look, you can see the direction of the channel is bullish. All happens simultaneously and gives usually phenomenal, nothing less, opportunities to trade. If you enjoy our content, if you would like to learn more, make sure you follow our channel.